Let's take that discussion forward. Sanjiv Bhasin joins in the show as always. Sanjiv, hi, good morning. Let's first talk about Tata Sons. Actually, looking at that fundraise, pairing stake in TCS, what do you think it implies for Tata Sons?
Yeah, good morning. Aisha, I think it's a routine, booking of profit or reducing stake. And they would be using that capital for extraneous purposes, maybe shoring up capital in other stocks, or, as their philanthropic causes do exceedingly well. But I think it's part and parcel of the proceeds which they do, systematically over a period of time. It will be a welcome step in the sense there will be enough people who will put their money where their mouth is. It should also see maybe a large part of the, a foreign portfolio be in, which should actually be better for the rupee. So I think it's a part and parcel of how Tata Sons manages its resources and how, they are reducing stake in the biggest hallmark company of the Tata Group, that is TCS.
Kunal, we've been chatting also, right, as to how TCS has now climbed up to its life high. You think the stock has topped out or peaked out for the interim?
So maybe from a short-term play, the stock may have reached a resistance point, but I don't sense that this is a sign of a major reversal for the stock, where it will probably correct and come back towards the the October 2023 lows, or the lows prior to that for itself. I would still believe that the stock is been into a very sturdy uptrend. So the only differentiation with TCS with respect to the other large cap IT stocks or even the mid cap IT pairs, for example, is the way in which the stock has moved up higher. It's gone through a very slow, gradual uptrend. The resistance have been crossed over by the stock price in a very gradual manner. And I think that indicates that when a stock generally goes into a low beta uptrend, even if there are few days of you say a sudden price correction, the stock has the capacity to try and digest those corrections and then come back again quite strongly. So I would believe that it's a sign that maybe a short-term resistance could be at play, but I think the near-term or the medium to long-term charts still look very, very positive.
Meantime, Sanjeev, was curious to get in your take as to how you're looking at competition now heating up within the paint space. Birla Opus pricing their products 5% cheaper versus Asian paints. What do you make of it?
Yeah, good morning. Awan, also on TCS, just to come in, in the last 5 years, they've done 3 buybacks. And if you did tender in the buyback at a premium and did not buy your stake, then you missed out on huge capitalization. 2,500, 3,500, 4,500. These were the 3 buybacks, if I'm correct. And each time the market, after giving the, tendering in the buyback, the stock has been up 40% from there. So I still think TCS is a numero uno stock, and at any price, it should be a jewel in the crown in your portfolio. On the paint business, yes, now this is going to be part and parcel, because we've seen that as housing and construction and capex pick up, paint industry is going to be very much in demand. I still think there is room for 2-3 players, and particularly the niche ones, to gather. For Grasim, it's a win-win point, given that they are using their other businesses, VSF and other the part of that, and cement, to use that as a corollary for paint, and diversification is a very, very big key. But I still think Asian Paint, Berger will be able to manage their market share, since the brand is eminently one of the best since decades. And I think that Asian Paint will be continue to be number one in that. They own they have about 53% market share in the decorative segment. So a little bit of price war may have an initial initial impact, but longer term, I think there is enough room for all three to survive.
Let's understand then a little bit, Sanjeev, as to how you're looking at the entire power space, given that we're looking at this mammoth shift from coal to clean energy now. How are you looking at some of these power stocks?
Yeah, so Avan, we are very bullish on the power finances, particularly REC PFC. From solar, wind, and now Modi ji announcing 1 lakh crore as renewables and solar panels. I think the lion's share of that goes to REC PFC. NIMs have been the best ever in the history of the company. And the guidance which we have from the company's results will be the best ever. And thirdly, state electricity boards receivables are at the highest ever. So all three parameters work excellent for the power lenders. and diversification of business, power being in a surplus position, all work well. On the other hand, we also know that Coal India has been a stellar performer over a period of time, as merchant coal prices have been extremely positive. But the realm of thing is that sooner rather than later, clean energy, green energy, all this will play out. Right now, I still think there is a time lag. So we would place our bets on NTPC, but REC PFC would be our two top picks. We think this quarterly results will be the best ever in the history of the company. And like I said, diversification across the board in all power verticals is seeing very, very good upside in on revenues and net interest income and margins.
Okay, since we're on the subject of power, it surely is one sector that is expected to scale new heights amid rising electricity demand as well.
Meantime, then, let's get in your take as well, Sanjiv, as to how you're looking at the entire tyre space, given the fact that you've got domestic rubber prices that have jumped nearly 23% sequentially.
Going to be a key negative for the tire companies, because we think sales have also reached a peak, and if rubber prices, the way they have moved, is telling us that the commodity prices are here to stay. That is why we've been bullish on metals on the China back, and we think that that is going to hurt margins quite substantially. And you've seen the stocks, particularly MRF, Apollo, CEAT, all hit all-time highs. So yes, profit booking would be the key over there. We think this is not a temporary uptick. This could last for some time. As this stabilizes, you could see some pressure on margins, because it is not easy to pass on the price hike right now. So, sell on rise would be the key over here. Book some profit. Get into some of the better names, like we've said, metals, specialty chemicals. Those are looking very, very, very attractive. And some of the large cap banks. We think those are outperformers. Along with that, we told you the key lenders, REC, PFC, those are giving you very good entry opportunities after the recent correction.
Sanjiv, so let's reiterate for our viewers who are just tuning in. What are your top metal and specialty chemical ideas?
So, Aisha, like I said, SAIL, NALCO and Vedanta are three picks which we have. For Tata Steel, it has been a big outperformer. We will have to see how the Talbot plant coke shutdown will affect, because that will mean that there will be some input costs. For Tata Steel, the next re-rating will be as fast that they can, get a hand on the unions and shut down some of that, or sell some of part of the assets of Chorus. But for us, it is SAIL, NALCO, Vedanta, and the Jindal twins. We think those are the best stocks to buy. Alternatively, buy a mutual fund which has exposure to commodities and metals. That could be a real outperformer in the near term.
Okay, those are some top recommendations. Meantime, what's the outlook then when it comes to the large cap financials, Sanjiv, in terms of your pecking order?
So ICICI, Axis, HDFC, Kotak, which we are very bullish. And we also reiterate that Federal Bank will be a key beneficiary of expansion of gold loans. They are now arguably in the top 5 bracket of gold loans, and agri and the franchise of liability is doing extremely well, as they are the largest recipients of inflows from the south. Along with that, we think RBL Bank is giving a very good opportunity. So if you bought 4-5 of these large cap and mid cap stocks, I think your portfolio should do just well. Thirdly, we also feel, Avan, that all the negativity on the higher yields and the stronger dollar is built in. Tomorrow could be the D-Day for us, with the Fed now seemingly prepared that rate cuts are on the way. I think yields and both the dollar are set to the yields are set to fall and dollar is set to weaken, which means banks will be in a very sweet spot over the next few months.
Sure. Okay, Sanjiv, great to have you on the show as always, and thanks for sharing your stock ideas as well.
If you like this video, then like, share and subscribe to ET Now.